Now, the title is very much true. I just had an article written about me, and the way that I value SoFi stock is incorrect, and now they're going to point out in this very long article about why I'm wrong. Now, before I jump into it, I will say the only reason how this video is even possible is due to Seeking Alpha, where this article was posted, and a longtime supporter of the channel. So, if you guys want to see articles just like this and a ton of investor information, go check the promo code down in the description down below. So, this is the article in question right here from IP Banking Research. Now, I don't know exactly who this person is, but I do want to preface this by saying that they've been very nice to me on our terms whenever we've DM'd each other or these sorts of things. And even in this article, he has nothing really bad to say other than the fact that we just disagree with each other on how to value the stock. But let me just read some of the key notes right here saying that retail investors are thinking of SoFi stock as a tech growth stock. And I mean, he's not wrong. I do kind of value a lot of my stocks considering that I am in the tech space. That's how I do value my stocks. But like he says, I see it more as a bank and I assess its valuation accordingly. SoFi is now an unsecured personal lender, and this warrants a higher cost of capital. I am unconvinced that SoFi has a sustainable moat in banking, and I remain concerned with the lack of profitability and risk profile. But Tanner, how do you know that specifically this was written about you? Well, he tweeted at me. Okay, listen to your presentation. This is one that I did on the SoFi Weekly podcast. He said, I think the gap in your analysis is that you're analyzing the company like a tech stock. It should be valued like a bank. I said I'd love to chat about this, possibly private or public, whatever he would like, but didn't get back to me specifically on that. Now, he also commented in this same article, he said, the reason for this article is a number of YouTube videos I've listened to recently talking about SoFi stock, which clearly from some 20 plus something investors. This was, a few days after he had sent me that DM. So it's definitely regarding me specifically. So let's just go through this article. I want to read a couple things that I noticed that I feel like, I have a couple comments on and how I value the stock versus what he's actually saying. But, let's just give it a fair little read here. So the first thing that he talks about is actually how he attended a conference a few years ago from a CEO of one of the large banks of America. This is what it says right here. And asked about if he's worried that technology companies like Apple, Amazon, or Google are worried about coming in and disrupting the banking industry, which his response, and he doesn't remember entirely, but it was something along the lines of, if these companies want to get in, be regulated to death as a large bank, potentially earn 10 to 15% on their equity and a low single digit revenue growth, I don't know why that would be such a large, attractive business model for large tech companies. Now, the only thing that I'll say about that is that what he's trying to refer this to is that it can't be considered a tech company because it doesn't quite have this growth and everything along these lines. But these single, digit revenues is just not what we're seeing from SoFi. We're seeing a company that's getting closer and closer to profitability. SoFi is still seeing 60+% revenue growths, right? So I don't actually believe that this is sort of a business model that can't be taken over by tech. I just don't think that, that's an accurate statement from some sort of dinosaur that's in the banking industry. I'm not saying that he's wrong, but it's also economies of scale. If you take a, $300-400 billion bank, yeah, I mean, they're going to be growing quite slowly. But if you're taking a, $4 billion company, for them to be able to scale up to that size, absolutely the growth rates can stay high. And I think it's sort of a bad example. And then also in this article, he talks about Goldman Sachs and how they scaled back their ambitions for their online-only division of Marcus, which was their online-only bank, right? Which he even says saw a lot of, growth whenever it came to deposits, but didn't quite have any plans because of their ongoing losses and absence to clear profitability and returns. Now, like I'm going to keep bringing up over and over, Lending Club has shown us already that this is a great business model. They're growing their net incomes like crazy. And so you can absolutely make a business model out of growing a consumer lending platform with, a total bank checking account, all these sorts of things to increase your deposits. SoFi is also doing this. They just haven't gotten their bank charter, as early as Lending Club did. I don't think it's fair to say that because one company has failed at doing something that it's a failed business model, right? You can look at Dyson vacuums, for example. They tried to make an electric car. Does that mean that we should go out and sell our Tesla stock because, one company couldn't make profitability out of a bad project? But then he goes on to say that, rising interest rates does make a hard environment for these stocks because it's going to increase default rates because some people are just going to get priced out of their loans, which I absolutely agree. I mean, there's nothing to sort of counter about that. I'm not saying that this is the absolute best stock right now. However, I'm saying it's absolutely undervalued for what people are placing it whenever it comes to its stock. And we can look at some of the growth metrics to do so. However, he doesn't like to look at the growth metrics, and we'll talk about that. This manifests in retail investors focusing on metrics such as top-line revenue growth, product numbers, and not necessarily, banking metrics like capital, return of equity, profitability, unit economics, and efficiencies, and so on. Said that retail investors like myself think that SoFi will be the ultimate disruptor of banks and that use growth metrics such as deposits, revenue growth, market share, and product numbers. Now, I think that's so funny. Market share, right? I just wanted to speak on that for a second. Market share in a growing total addressable market, especially in an industry as large as finance, right, is by far the number one metric across the board for any sector. The reason why traditional banks don't talk about things like member growth, product growth, or even market share is because they're actually losing in those metrics. So they want to point you in directions such as return on equity, which essentially is how much money can we make with what's left. So they take their already existing capital and say, okay, we can make 15% on this per year. So isn't that, so exciting that we can continue to get 15% on the money that we do have? Imagine if we're able to add to that. But they're not adding to it. They're actually losing in things like deposits. Now, maybe that's not the right thing to actually, base it on. But what I like to assume is that if we can actually grow the business by 60%, year over year, and then maybe we can only get 10% on that per year, like way less than the legacy banks, let's say 5%. We are still growing the overall business by 60%. And then on top of that, we're growing what we already have. Now, that's a disgusting oversimplification for how the banking industry actually works, but it is important to understand that I would rather get the new customers that are looking to leave their traditional banks than worrying about how to actually increase the total monetization of our current clients, which we're still doing anyway. I'll give a little spoiler here for the article, before we actually go on though, but he never goes on to talk about anything along the vertical integrations that we have or Technesis that's expected to save us $70 million per year and how that's actually going to affect our efficiency where, these legacy banks are actually coming to us to help them, get these processes straight. So obviously we have something that they want and that we can actually sell to ourselves. Not to mention even things like, branches, for example, just keeping branches alive for Chase, right, is some of the most expensive costs that they can have as a bank that comes in at an absolute net zero for SoFi. So you can say that SoFi is not worrying about their return on equity and these sorts of things, and I'd actually agree with you for the most part. But the problem is that in any company across the board, I don't care if you're a bank stock, tech stock, or anything in between, your products and your user base that you actually have is the number one metric. That's what lays your foundation. Everything on top of that in terms of efficiencies and everything along those lines is what you build on top of your customer base. And these legacy banks are getting their bottom of their, pyramid chipped away. And what's going to happen with the top of the pyramid whenever they start losing customers at a faster rate? It's not going to matter with what your return of equity is, right? Or else they're just going to be, the Berkshire Hathaway where they're just holding companies for money. I don't want that. I want a real product, a real service, and then we can worry about the efficiencies. Now, another problem with this article is just not seeing eye to eye. If you value SoFi versus the legacy banks that have been doing these sorts of things for hundreds of plus years, obviously we're not going to have some of the metrics that they do whenever it comes to things like return on equity. But just because this company has a bank charter doesn't necessarily mean that it has to be valued with those same metrics. When did we ever, out of any other industry, not think that user growth and product growth is the number one metric to actually focus on with a company as long as you're seeing net profitability, right? If we can actually increase our margins, which we're expected to on all three of our things, on our lending side, we're expected to increase our margins, and we have been, and on our financial services and on our technology platform, which is supposed to expand margins by the most, right? 30 to 40%. That's what they're expecting. When did we ever switch away from just valuing a company as a company, right? Growth rates, net profits, free cash flows, these sorts of things. Or if you're valuing an actual growth company, what is the future prospect that we can get this stock for a cheaper value, but the expected chance that it does get to those metrics is, higher than the risk of it going to zero. That's how I value SoFi, is as a regular growth stock, the way I value any other stock, right? And the number one thing that I love to look at as well is total addressable markets, because that means that even if you're staying stagnant as a business, you will grow because the industry is pulling you that way. If you can actually be a market leader, then sky's the limit for your growth. Now, I also wanted to speak on this part because he had a problem with this, was our capital position on SoFi. Now, I just had recently done it. I think you can find the link right there where I actually spoke about SoFi CET1 ratios and how I actually really like the ratio. But he said that our minimum was 7%, okay? And that whenever you compare it to a company that's very similar to ours, which is Lending Club, obviously, right? Because we both have a very personal loan-esque business, and I don't disagree with him whenever he talks about that. But they're actually maintaining a minimum of 11%, right? Or I think their actual amount is 15.2%, but their minimum is set to 11% because they have a riskier style of loan, which so does SoFi, right? But he's saying that the 7% minimum is actually, misplaced and it should be going up. The problem is that we're at 16.4%. We're nowhere near. And in fact, even if our minimum was something along the lines of 11%, we would still be much higher than this, even higher than Lending Club, the example of better banking that he, sort of used, which whenever you actually look at his Lending Club article that he just written today, he also put Lending Club as a strong buy, but SoFi as a, hold right now. He's not even saying sell the company. He's just saying that he's skeptical. A note of optimism, right? The recent acquisition of shares by SoFi CEO are certainly a good sign for bulls, right? The evidence shows that a large percentage of SoFi deposits are done through direct deposit channels is also encouraging, and the ultimate success of the online bank, in my opinion, is somewhat dependent on the ability to generate sticky deposits at a low cost. Finally, I will be the first to admit that I do not have a good grasp on SoFi's technology division and its prospects. I am very early in my learning curve in this space, and I'll update my thesis accordingly. A lot of the problem is that these costs are intertwined in some ways. So then, if you are actually looking at things like the amount of, stock-based compensation, you're looking at that versus a bank in general. Well, you're not also comparing it to, we have to pay Derek White, the CEO of Galileo. And how does that factor into our actual costs overall, right? And so we do actually have a bit of our company, 20% roughly in terms of a revenue share, that is going to a completely different side of this business that will build out, the full, prospect of the company. But it's like valuing Square stock or Block Incorporated now as just being Cash App or just being Square Technologies. You kind of have to factor in them both because that's what you're buying whenever you're buying this stock. This also doesn't nearly factor in how the financial services part of our company is expecting to grow to over 30% of our overall business by 2025. Right now, it's only 11%. So we're expecting a tripling in the next 2 years, 24 months to triple that business. But the fact that the technology services also are expecting to grow from 20 to about 26%, over the next course of that little bit. And also the margins are growing, like I said, from 30 to 40%, a massive increase. So I do believe, whether or not he wants to hear it, is that this is more than a bank. We have a bank charter, but we are a full technology company and we are a tech company, right? Like we do have all the things that make up a very similar play to what Block or Square is trying to do, right? Where we're building out one side of the business, we're building out another side of the business, and they're supposed to intertwine very, very easily. Now, I also want to add in what Chris Hager has actually said, okay? Which we've had him on the SoFi Weekly podcast, but he says, you're not actually valuing the bank correctly. SoFi Bank has a positive $50 million in GAAP earnings in Q3 of 2022, which is a 20% ROI on its $1 billion of capital in the bank. If you're going to strip away it to just being a bank, then you should do just that. And they go back and forth on, everything like this. So please go check out the actual Seeking Alpha article if you actually want to read more about that. Overall, this was a good experience to get this article. I mean, I do want to go over some of those banking metrics and see how SoFi compares to some of the legacy players, right? Instead of just comparing us to the new banks and, Ally Financial and everything like this, which is more of an appropriate place that I think that we should be compared to. But, if he wants to compare us to the Bank of America's and JP Morgan's, I'll show you guys some of that as well. But I think that this is a case of an older style analyst, something like an old auto analyst trying to value Tesla and not understanding why the stock had just absolutely skyrocketed because they don't understand about the energy part of this, or the fact that it's not a car company, it's a data company, or the the networking charging stations or anything along these lines, right? It's not being factored in at all. So if you're not factoring in the technology business or the vertical integration or anything like this, then you're going to get the price of this absolutely wrong. There's a difference between the stock price, which has, been getting crushed. We're in a bear market in general. Apple stock is going down. But versus the actual stock, which we continue to see triple beats over and over and over. And I'm going to assume that we're going to continue to see that, considering the fact that Anthony Noto has been buying shares before Q4. That's just my estimate, however, even though, we lost student loans and these sorts of things. But don't just take my word for it. I just looked this up, right? You can look at analysts as well, seeing a 55% increase. So you don't have to take it from a 20 plus some odd aged investor on YouTube. You can go ahead and take it from the, the professional analysts that are valuing this company, also at a 55% increase. But please, if you guys like this video, I'd appreciate a like, a subscribe down below, and go check out that Seeking Alpha article and the promo codes down below. That would really, support the channel. And go follow my man, IP Banking Research. Hopefully, guys, I will see you on the next video. You guys have a great one. Bye for now.